Hey, good morning, everyone. Marty Missouri here, Monday, the 9th of August, 2021. In this weekend's macro video, I said I'd come back to you with some technical analysis on the positions that we have. Looking at gold this morning, and then we're going to look at the overall market. And that's it in terms of technical analysis. Then I want to go back to some history and show you the US market using the S&P 500 as our proxy, and then our top 5 positions in our core portfolio using the indexes that the ETFs that we have represent. Purpose this morning, again, is to keep my promise about the technical analysis. There are a number of you who have reached out to me who enjoy those, find them instructive, and so on. So I'll do more of that, but I want to keep these quick. So I'll keep coming back with different positions, with different commentary, and with any luck, keep them to just a few minutes. There's an overall case, though, that I think I need to continue to make with regard to our positioning, our feeling about inflation or the reflation trade going forward. Don't know how deep I'll get into that in this monologue, but more of that to come when we get into positions like the industrial metals and so on. If you'll recall, those of you who watched Saturday's video, I said the gold is getting interesting from a technical perspective. So we'll start there and I'll tell you what I was seeing. So this is GLD, which is the ETF that tracks the gold price. So we'll use this as our proxy for gold, and it's the position we have in our portfolios. So this is a 2-year daily chart. The blue is a down day. The white is an up day on these candles. I know this is a busy chart, forgive me, but I'll make sense of it right here. So notice, let's go back just to kind of set the stage. Notice right back here into the beginning of 2021, this pattern right here is what you'd call a declining wedge pattern. So when we can find these, when we have momentum indicators via our MACD, moving average convergence divergence, and then the relative strength index RSI, that are actually showing what we call here bullish divergences, well, then that's a real bullish setup. So as you can see, we had the falling wedge, we had a situation here where we had a bottoming, and then we had a testing of that bottom, but during that same time frame, we had these indicators actually not coming down quite as far. So that is what we call a bullish divergence. So we had a really nice run in gold for, call it a few months. And then we were kind of in this channel right here, and then we began developing a rising wedge pattern. And right here at the top, the beginning of what looked like maybe some rolling over in the momentum indicators. So that was a bearish pattern. Sure enough, we broke out of that. And then we broke below the 200-day moving average, the blue line, and with some momentum. So we came in here, had a gap right here, as you can see. Now, a lot of technicians play the gaps because they tend to get filled. And sure enough, market came down, and this is what was getting interesting, and I'll get to that here too, and fell right against this area right in here, which was resistance back in, the early to mid 2020, right? Then it served as really notable support, right? Came down through there, tested it once, and then it became support again. So we came down, tested that successfully, tested it again successfully, and then started doing battle here with the 50-day moving average. So what was interesting to me was not bullish, it was bearish, right? We tested the 200-day moving average. The 50-day moving average began to actually curve lower. And we had what you can call this little mini trend line here, just got busted through last Friday. Okay, now so that was on the jobs number, and bonds tanking and interest rates rallying, right? Presumably, economy is much better than anyone expected based on that jobs number and so forth. But really, it's fear that the Fed may tighten monetary policy sooner than later. And gold's trading on what we call real interest rates. That's the nominal yield minus inflation. So if nominal yields are going to go higher and inflation isn't such a big thing after all, well, then gold doesn't look quite so attractive. What was interesting to me, though, was yes, that was bearish, but it came right down and rested on top of what I would call this real defined buy zone in here. I was actually kind of expecting a bounce off of here, frankly. Well, when the Asian markets opened up last night, Sunday, gold absolutely got destroyed. And I wrote about that in the morning note. Somebody with a huge position unloaded, and I'm going to say had to unload, because you don't unload a huge position unless it's an absolute have-to situation. So why would somebody have to unload $4 billion in notional value of gold onto the market, at the market? Well, it's probably because it was done to them, not by them. And I'd have to conclude that it was, barring some central bank or something, which I doubt, I'd have to conclude that it was a big whale out there who was heavily margined. Now the question is, was it gold that they were margining, or was it just gold that they sold to cover the margin call? And the margin call is where the equity in your portfolio, in your account, gets below the broker's threshold, and you got to either come in with cash or sell what you got. My best guess is that after Sunday's big decline in gold, that somebody was crazy bullish on gold, levered up to really exaggerate that bet, and it went against them on Friday, and they got a margin call, and kaboom. So gold was down, 4%, if not 5%. I think it was down $100 an ounce at one point overnight. And then it rallied off of that level. This didn't get to reflect that, but it would have taken it down in here. We got concerned up in here about gold, and we began hedging it. So last time I looked this morning, it had mitigated about half of today's decline. So I'm bullish gold for very solid reasons, for an extended period going forward, and it is a very good hedge against a big deflationary shock, which would be a big market collapse. But it's also the ultimate trade when we have a situation where we really need some inflation to do battle with the government debt to GDP, but we have a debt bubble that doesn't allow the Fed to really meaningfully tighten monetary policy. And we've got initiatives that have to do with climate change and all these things that are going to require a phenomenal amount of government borrowing and spending that just doesn't allow for interest rates to go up meaningfully. So in some respects, you have what's needed, and that's going to be inflation to bring down the government debt to GDP. And you also have a setup that is ultimately made for things like gold and for the industrial metals. That was where a lot of the money is going to be spent. So there's your look at gold. So let's take a look at the S&P 500, and I'll show you what we're seeing there. For starters, this volume indicator. So this is the 10-day average volume, the yellow line, moving average, and then here is a kind of a threshold that when we get here, things tend to happen. So low volume means low conviction. So when the market's rising on very low volume, that tells you that there's just not a huge amount of bullish conviction, despite the fact that the market's rising. What it tells you is just lack of sellers, not necessarily super motivated buyers. So when we have these extended positions, these periods where we drop below this line, and that's highlighted here by the circles, stuff not so good tends to happen in here once the market begins to roll over. So here in 2018, we had that 20% decline. There was a lot of things that were going on there, but we had really, really low volume. We had a rising wedge. I'll show you some other divergences we had. And we had the market take a hit. We had a 10% hit back in here that was preceded by low volume as well. So you can see, and then we were just kind of building this long middle here with a few spikes before the tremendous waterfall sell-off that we had for 3 weeks back there in February, March of last year. And then notice that where we came down and touched this line, ironically, not every time, but for the most part, the market got into a little trouble. Now we're kind of working on an extended period here where, you could say again, we keep touching that line or getting close to it amid, a rising wedge pattern that we've actually kind of broken below right here. Still, that 50-day moving average sure seems to be solid support. And I suspect it will be going forward, but these are just things that, have our attention. Pulling up the moving average convergence divergence, that momentum indicator that I just showed you on gold. Notice that back in here, indeed, we had a bearish divergence, lower high, while the market was hitting a higher high. We had, this rising wedge pattern in here before we took a pretty good hit. We just had continuing long, slow moving divergences, just not really confirming these highs. And then of course we had the big one back in March of last year, February, March of last year. Then we had a rising wedge, the bearish divergence took a hit there. Long rising wedge, long bearish divergence, really looking suspect in here. And then the RSI, Relative Strength Index, we have, same thing, same look. Pretty much what I showed you on the MACD is the same thing we're seeing in here on the Relative Strength Index. These by themselves are not sell signals. Sell signal is when you break down out of the wedge and below, in this case, the 50-day moving average. Then we have some pretty good hits to take. And folks, we are going to see these, right? The question is, how far will they allow to go before the Fed steps in and frankly begins buying stocks? That remains to be seen. But yeah, this market continues to look heavy, continues to do well. And by the way, August and September are the only 2 months of the year that have long-term average negative returns for stocks. So folks, if it gets choppy and gets kind of weird, seasonally speaking, it's supposed to right about now. Okay, and lastly, here is a long-term look at the S&P 500, the white line there, Europe, Euro Stoxx 50 index, which is, we use an ETF that tracks that. The purple is emerging markets, and we use a Vanguard ETF that tracks that index. The light blue is agricultural commodities. We use DBA, Ag Futures ETF. The blue is Asia Pacific, and the orange is gold. This time period is the tech expansion. 1990, the wonderful decade of the 90s, greatest bull market ever until the last one. And then all the way up to when the market topped in March of 2000. And as you can see, the place to really be were simply in equities, US equities and European equities in particular. Now let's take this to the bottom, which was March 6th, I believe, 2003. So this is the bottom of that tech bubble bursting. So obviously the ones that took the biggest hits, right, are the ones that were doing the best, US and foreign. Didn't quite catch down to these relative to the 1990 starting spot. But boy, what a bloodletting. You can see gold actually held up quite well during that time period, as did ag commodities, relatively speaking. Asia Pacific, took a big hit as well, of course, as did emerging markets. So we had a period of huge equity outperformance, then huge underperformance. But really, the U.S. didn't really have much, or if anything, on Europe at that point. So now I'll take it from the bottom of the tech bubble bursting to the top of the next bull market between the two bubbles, which pretty much topped out in November 2007. So during that period, that emerging markets were the place to be, right? Which they weren't the place to be previously. Asia Pacific did very, very well. Gold even outperformed the US stock market at the time, as did European stocks still, but again, they weren't a great place to be relative to the previous period. Here are US stocks and ag commodities just kind of floundering around in there during that time period. We didn't own any ag commodities. We did own gold for a stretch during 1999, and then we didn't own it after that. And of course, we did have a lot of US exposure, but we also had a lot of emerging markets and foreign exposure. So right in through here, it was easy. And I recall, in fact, I don't recall ever not outperforming the S&P 500 during that stretch. Now let's take a look at what happened by the end, which ironically was March again, of the real estate and mortgage bubble bursting. So gold, all things considered, actually held up pretty well. Emerging markets got absolutely creamed, as did pretty much everything else in the equity space, and even ag commodities took a header. Okay, so from the bottom of the real estate and mortgage debacle right up to today, now we've had just an absolutely epic run in US stocks. I mean, you can't exaggerate how insanely outperforming US stocks were versus the rest of the world, versus gold, versus ag commodities and so forth. So these X's right here, I put those right where we began to mix up our portfolio substantially. So right up until here, we were pretty much all in on the equity trade. Well, right in here, in about August of 2019 is when our macro assessment began to roll over. So here we began hedging portfolios. We started with an options collar. Okay. Here in December, we abandoned the options collar and we added gold to the portfolios. We increased our weightings to some of the non-US stuff. And right in here, and it was about closer to mid-2020, we added ag commodities futures to the mix. So we weren't in those yet, just right here. We continued to hedge, but we didn't have the short call position. So we abandoned the collar, went a little out of the money, further out of the money on the put options on the S&P, and then really began to diversify the portfolio. So clients, you'll recall, we had a great time in here. We did not capture the lion's share, not even close to that decline, and that was great. Now, since then, though, the U.S. market has pretty much picked up where it left off, and we know why. The U.S. has been the most aggressive stimulator of its economy, both from a monetary policy as well as from a fiscal policy standpoint, far and away. And while macro conditions still had us very, very concerned, relative value and valuation said, you don't want to play there. Let the S&P go as far as it wants to go, and don't worry about whether or not you keep up with it. This is just not a place to go hog wild. Something to own, but certainly not a place that you'd look for great fundamental value. So folks, we now have more of our weighting in the Europe, emerging markets, and Asia Pacific developed. And then we have a good chunk of gold, which is one of our top positions, and a good chunk in ag commodities. Okay, we do have a decent chunk in U.S. stocks as well, even technology stocks. But we're favoring in the U.S. things like materials, mining stocks, renewable energy stocks, industrial stocks, and so forth. We want to take advantage of trillions of dollars of infrastructure spending and the big push to renewable energy. So when you look at this and you look at it as an investor who really wants to own value, and so you look at valuations, you look at dividend income from equities, which is better in the foreign stuff. But then you just look at trends, and you look at what I just showed you historically, right? I showed you a period where the U.S. and Europe outperformed, and then they were dogs relative to some of this stuff. A period where the U.S. was a dog, right, relative to a lot of this stuff, and now a period where U.S. has just run off, and we have probably the biggest gap in history. So two questions to ask, right? When you look at this in the context of history, in the context of trends, in the context of how things tend to revert to the mean, first question, where do you think the greatest potential returns going forward are going to be? Which area? Any of these colors here, or this white one that's gone through the roof already? Well, I think most people, certainly experienced investors, or people who have a feel for just how things trend price-wise throughout the economy, would probably say, well, it's an easy one. You'd say the potential for the upside is probably greater down here. So we can look at it that way. Or we could say, which of the group has the greatest potential for big precipitous declines coming off of these levels? Which one looks like it's peaked to roll over, right, in a big way or in the biggest way? Well, I think most people would answer the white line, right, the S&P 500 in this example. So our job on behalf of you clients who are watching, and I know some of you aren't clients, and by the way, the disclaimer, this is not advice for anybody. This is really designed to be examples for clients as to why we're doing what we're doing. But from a risk-return standpoint, I think I just answered that question. Where do you want to emphasize your portfolio? Where do you want the emphasis to be? On top of that, to the extent that we're here, and I mentioned the gold hedge already, we're also hedged energy a bit extra, and we have hedges on the S&P 500. So, of course, in a big liquidity crisis, and that's what happened to gold last night for a moment, all things are going to go down, even the good stuff, because it's going to have to be sold to meet those margin calls in my example. And we think, that potential is always there when we look at a market that's run that high. So going forward, folks, we think the smart thing to do is to certainly exploit opportunities where you see value, right? For sure, right? But even there, and especially here, protect yourself. Do it through broad diversification. Buy things like gold that tend to do well when the world's coming to an end, once the dust settles anyway, or once the first bit of dust settles. And then, but then hedge, be creative, and hedge using derivatives, which is what we're doing on behalf of our clients currently. I'll leave it there for now. Much more to come. Again, I'll take you into the weeds on some of the other individual positions. Thank you so much for watching and listening. Be back soon. Take care. Bye-bye.